Our final presentation for this bracket is from Strandline Resources, and Luke Graham is the Managing Director. Strandline is about to become a major mineral sands producer at its Coburn project in WA. It has started early construction work. It has completed a host of key supplier and binding offtake contracts, and it's currently in the process of finalising funding. With a market cap of around 100 million at the current share price, Luke's here to tell us about why that number is going to go a lot higher over the next year or so. Please welcome Luke Graham.
Good afternoon, everyone. Thank you, Mr. Reid. Bit of a shout out to the guys on the Gold Coast and online. Thanks for making some time to listen. Let's see if I can work this. Okay, we'll start off with, so where are we? We're in the two largest producing jurisdictions of the world in terms of mineral sands, and that's Australia and Africa. The Coburn project is our flagship project here in WA, and that's the project that is poised for development. To complement Coburn, we have a series of projects at various stages of exploration and advancement, if you like, down that coastline of Tanzania. And that southeast coast of Africa is a significant producer of mineral sands to the global market, and we're strategically located right in the middle there. So what I want to do today is really focus on Coburn, because that's the project right here that is quite easily going to demonstrate that big valuation gap between our share price and market cap and our valuations. So I brought this slide forward from the back of the presentation, typically just for this audience. Really the figure on the right. We've been doing a lot of evaluation, feasibility study and exploration to get to this point, and 3 studies have been released over the last year or so. The Coburn project, you can see NPV of 705, and that's underpinned by the first 22 years of all reserves. It also has an extension case for another 15 to 17 years further north and along strike to it that will convert to reserves over time. Very exciting generational size project for WA. And you can see our market cap right on the right-hand column at 107 million. We've got about $1 billion worth of valuation gap between our combined 3 projects of NPV right now today, which is crazy. So let's get on and run through the corporate snapshot, and then we'll go into the project in more detail. Sorry, skipping through a bit quick there. ASX listed, STA is the ticker, 20 million cash in bank, as I said, 105 million market cap in Australian dollars. Tempo Capital, private equity group based out of London, is our major shareholder and has been for the last 4 years. And hugely supportive of all our work to date, and certainly supportive of our transition and our transformational change into development in the very near term. We've also got quite an institutional shareholder register, and that's mainly biased with Australian institutions that have recently come into the stock in the last year or 18 months. Top 20 own 64%, so quite tightly held. We're well covered in terms of expert analysts in the sector. So Andrew Hines at Shaw & Partners, Chris Brown at Morgans. We've got Foster Stockbroking and also Trent Barnett at Euroz and Hartley's following us. And they've all got hefty price targets on us, a lot more than what we are trading today at 20 cents per share. Having problems with this. On the board, so well led by Didier Messier. He's actually been on a few slides I saw in the last few presentations. So he is well regarded, well renowned in the resources sector. He's also the honorary consul for Tanzania for Australia, which has held us in really good stead in all our work in Tanzania, stakeholder engagement and paving the way for us to navigate through the mining reform that has somewhat slowed us down in our development aspirations in Tanzania, but certainly starting to take shape as they're bedding in that new legislation. My background is development. I'm an engineer originally, and been in the resources sector for over 25 years. And what I've brought into the group is just a team of specialists, and you need specialists from the mineral sands sector itself because it's a bit of an opaque sector in that regard, but certainly around me and the board is a group of really experienced developers and operators. So a bit on the market. So mineral sands is used in everyday life. The applications are from paint, pigment, titanium pigment production, which is paint, paper, ink, and also titanium metal, which is used in the aerospace sector, and other applications such as welding rod applications for the construction industry. Then on the zircon side, you've got the ceramics, which is the biggest demand for mineral sands, and other applications such as refractory and foundry. What's really important when you've got projects ready for development is that they're getting pulled forward by the market, and that's exactly what our projects are right now, and particularly the Coburn project. There's a significant emerging supply gap that is, as I said, emerging right now in the sector. COVID somewhat softened that deficit this year, but really exciting to induce new projects. And you can see existing supply coming off year on year for the zircon graph there in the middle, 3 to 5% year on year, and that's because of declining grades or mine closures or shortening of stockpiles, etc. And then you've got an underlying demand of global growth. Because of its applications, it's largely linked to urbanisation and rising living standards and things like that. We have a bit of a perfect storm right now with the stimulus that's just been getting injected across a lot of the major economies, and particularly America and Europe right now in this sector. So what a fantastic time for us to be getting induced into the market. This slide, I guess the key takeaway here is you've got the zircon stream and you've got titanium stream of products. And really in industrial minerals, whether you're in lithium or graphite or rare earths or zircon or titanium or even in iron ore or coal, you really want the product quality to differentiate. And that's exactly what Strandline does. Our zircon hits the ceramics market, which is the higher end market in the zircon market. So, and that gets a premium price. Our titanium is appropriate for the TiO2 pigment sector, which is the largest part of the market in that space. Coburn itself will produce about 5% of the global zircon demand. It'll also produce about 10% of the global chloride ilmenite demand, so it is a material project in our project ready to be developed. So the next part of the presentation will start to drill down into Coburn specifically. I really want to feature that here today. It is a world-class asset. It's in a great jurisdiction. We all know that WA is one of the best mining jurisdictions, and that's certainly been emphasised through this last 12 months with COVID. Our mining sector here in WA hasn't skipped a beat, really. In fact, we've increased production across most of our commodities where Africa has dropped, and South America, for instance, have really been impacted and more of a disruption in those, whereas WA has really stepped up and filled a lot of that void globally through this period. So that's just emphasised it, and I'm getting a lot of that feedback internationally from the investors and that I'm talking to right now at this important time. High margin cash flows. So Coburn itself, I mentioned the NPV, 705 million pre-tax. The IRR is in a good space, but really, where do you sit on the cost curve against your peers? And we sit really well in the revenue to cost ratio, 2.4 to 1. So as you can imagine, all these commodities are quite cyclical. You really want to be right up in a good part of the cost curve to be able to maximise your margins, number one, but also be protected against some headwinds that you might get, and ultimately you do over a life of, say, 40 years, such as Coburn. So the EBITDA over the first 22 and a half years of the ore reserves are 2.3 billion. That's 100 million EBITDA per annum for that period on average. So I mentioned my market cap of 100 million. So 1 year of earnings before interest tax is equivalent to my market cap. So 1 times EBITDA right now. So if you're thinking about valuation, there's a metric for you to just mull over as we get on and deliver this next few milestones to development decision. It's critical minerals. See the figure on the right there, what we've done, we've been able to attract a really strong debt solution from the Commonwealth Government of Australia. So they've seen Coburn as a strategic asset itself. They've got a mandate to really enable projects of this type of nature in the northern part of Australia. So critical minerals, fantastic, tick. High Indigenous engagement, tick. A lot of public benefit and employment, tick. And it's all those sort of key things that have got them through, I guess, the various stages of their selection. And plus, obviously, it's got to be a bankable project and really strong in the cost curve to make a good credit case for the government to get behind it. So they approved mid-year $150 million tranche for this project, which is one of the biggest mining investment tranches that they've approved. And I've been working with NAIF now going into the legal facility documentation and getting all that critical senior secured documentation and intercreditor documents, etc., in place through this last quarter, and really now at a definitive level. During that period, we've also been working with various other lenders internationally and also in Australia for a commercial debt tranche to sit alongside NAIF. So one of the key things with NAIF is it's a 15-year tenor, which is quite unheard of for a greenfield development project. Normally most greenfield projects will have a debt solution that will be paid back within 3, 4, maybe 5 years at most, whereas the government, because of our longevity of our ore reserves and our quality of the project, they're looking at 15-year money, which is like a long-term bond money, which is fantastic. So we've got a commercial debt tranche, so that's really enabled us now to get that commercial debt tranche negotiated, and hopefully that'll be the next key milestone for the company to just put that piece of the puzzle together before a FID decision and get on with things. The project itself is $260 million capital all up, excluding financing costs. And normally what you would have in financing costs is interest during construction would get funded up front. You would also have things like working capital facility, so that transition into production, which gets funded up front. Some other financing, establishment fees and charges of that sort of stuff. Normally, you'd also have a cost overrun facility that gets funded up front. So $260 million, excluding financing costs, is what we're going for. And NAIF's got that $150 million tranche, and we've got a commercial debt tranche, which we announced recently, which our target is around 100 million Australian dollars. So you can sort of see where their equity shortfall will be in due course. One of the key things in getting your project bankable, number one, and also in industrial minerals is, and getting certainty in your sales and your revenue streams, is the offtakes that you have. And I'm pleased to say we've announced 4 major offtake agreements through the course of this year with the biggest players, the most reputable players around the world in their selected downstream industries. So we're 72% contracted for the first 5 to 7 years, which is great. And I'll just go through the products individually. So as I mentioned, the premium zircon, that's going into the high-end ceramics market. So the 2 big zircon markets globally are China and also Europe. So we have off-taked with Industry Bertossi, based out of Italy and Tuscany, and also Chilches Materials, based out of Spain, who are owned by the large Torresid Group. So we've chosen to go to Europe, and we get that high-end market. And they're 2 of the largest zircon consumers in the world, and most reputable, and have been growing their businesses through the decades. With our ilmenite product, which is that 62% TiO2 content, titanium dioxide content, which is going into the downstream pigment sector for paint and paper and ink, what I mentioned before, and plastics. It's going to America. So the largest titanium consumer in the world, called the Chemours Company, is off taking 100% of our ilmenite for the first 5 years. And that's on a fixed price that will increase by PPI each year through the term of that. So it's like a CPI index here in Australia, normally 2 to 3% year on year. So that gives us a fixed price in our revenue stream, which you do not normally get in industrial mineral applications, because mineral sands isn't an exchange-traded commodity. But to have that is a really strong solution within in our revenues. The rutile is uncontracted at the moment. And if you kind of go back a few slides when we were looking at those graphs, you could see the rutile dynamic, supply coming off rapidly right now and through 2021 when we'll be building this to a really dire market in terms of where production's coming from. So it's deliberate that we haven't contracted that one just yet, but in time we will. And that'll be a really strong solution, I have no doubt. The zircon concentrate, so what we do to de-risk our circuit is we keep things really simple. So we take that premium zircon I said, we take the ilmenite out of the circuit, we take the rutile, and then all the minerals that don't efficiently report into those circuits, we get into a concentrate. And we also pick up a rare earth mineral called monazite in there, which we get payable credits for, and just some titanium credits. So it's a really good way, and that's going into China. It's about 20%, 25% of our revenue. And it's going to one of the largest zircon consumers in China called Sanxian, and they're a Shanghai-listed stock exchange company. And as I mentioned before, China's one of the biggest domestic markets in the world for that, as well as rare earths. So what does the mine look like? Up there in Shark Bay, north of Geraldton, there's a lot of sand. So our ore body is about 30 kilometres long from north to south, and it's about 3 kilometres wide, and it's just a big journal system, 3 journal systems, and we're progressively mining it. And what you do, you dozer push into a dozer trap, we draw water from the aquifer, a big Carnarvon aquifer that runs under the ore body. We put it into a slurry, then we pump it to the wet concentration plant. Very conventional, so nothing that we're doing in this project has not been done before. What we are doing though is using the most modern generation technology and configurations to extract the mineral reliably and add the best possible value to it. So dozers push in. We have 2 dozer mining units running at any one time, and then we progressively extract out of the ore. It's about 1 to 2% heavy mineral, and we upgrade that to 95% heavy mineral through 4 or 5 stages of separation. And then we separate that mineral, that wet concentrate, into final products, and then we send it to the Geraldton port, which is 250 kilometres south of it. One of the richest basket price of mineral sands in the world, because of our bias to zircon and our bias to the high value rutile, as well as that chloride ilmenite being a higher spec than a sulfate ilmenite, for instance. Very steady cash flows. This comes back to the valuation gap. You can see our revenues averaging just around 200 million Australian dollars, and our operating costs very consistent. The reason it's very consistent is because we have a homogeneous ore body. It has quite consistent head grade through the life of that 22 years of ore reserves, but it also has a homogeneous or a very consistent assemblage, so a makeup of those valuable minerals, which allows us to get to a steady state and just set and forget to an extent with some minor optimisation over time. To get to this point, we've had a lot of partners, as you can imagine. Even though I've got a fair bit of depth in my team right now, and we're building right now as we get onto the early works on site. We've already got our pioneer camp set up. We've started to establish activities there, which is great. But we've chosen what we consider the best in class, and this is my background. Where I come from is building and being involved in construction and operations, and we've gone from our consultants on the left now into our implementation partners on the right. And if you've been following Strandline, you would know that over the last 3 months we've been progressively announcing major contracts to give us certainty in our costs, give us certainty in our schedule, and prepare and set them up for success as well. So we're doing front-end engineering with some of these guys right now, so we're getting ahead of the game to help us de-risk and give us extra confidence in development. This calendar year has been huge for us. We're ticking the boxes. We've got a few boxes to tick this quarter, and hopefully we'll be out into ramping up construction through calendar year quarter one next year into production in 2022, which will be a fantastic time in our view in the supply demand, and that's a fantastic time in terms of our off-takers The only reason they're signing up to long-term offtakes is because they're really concerned about the supply-demand fundamentals. So just in summary, 30 seconds, it is a strategic project, it's world scale, it's in a great jurisdiction. We have a very rich assemblage, conventional processing, conventional mining gives us confidence in reliable recoveries in production. Top shelf customers that are backing it, fantastic debt package with the Australian government behind us as the major lender for this project. So they are the simple majority lender, which is great to have, and we wouldn't get that on board unless this project was bankable. And we've been working with NAIF for the last 2 years. It's environmentally friendly because there's no toxic elements, and we backfill progressively and then rehabilitate fully, which is a really good strength. We're construction ready and looking forward to getting on and rolling up the sleeves and getting some sand under the fingernails over the next few months. Thank you.
Thanks very much, Luke. Luke, an investor, has texted in a question to ask you. He says, what differentiates Strandline from some other existing mineral sands companies which have had a less than impressive performance in the last 10 years?
Okay, well, range of things. I'll start again for 15 minutes. No, look, it is in a great jurisdiction. The ore body, as I mentioned, justifies a conventional processing, so we don't have to acid wash our mineral, we don't have to wash our mineral, so that gives us a lot of confidence. It's a 40-year project essentially as well, and we've done a lot of work to get to this point. We've spent about 40 million Australian dollars to get to this point, and we've got some very good partners across the board. So we're looking forward to getting in, plus it's high margin.
Great. What do you see as the key re-rating points for the stock over the next few months?
This presentation, and then no, look, the key milestone which I think everyone's looking out for is the commercial debt tranche to sit alongside NAIF. Once that's secured by the company, which we've been working hard for some time, it'll pave the way through into development, and it's really quite an interesting sector, mineral sands. We see a lot of vertical integration, so the downstream consumer taking a stake and trying to get involved upstream to the mine. And you see that in a lot of other commodities across the world, but it's really happening in mineral sands because the downstream consumer is getting more and more nervous about where they're getting good quality supply, and our product quality differentiates. So our view is that once this project gets moving, it's going to get a lot of visibility on the global scale in this sector. So thank you.
Excellent. Great. Thanks very much. Great presentation. Please thank Luke.